Hi, welcome back to Cheryl Trades Leaps. Most traders lose money with leaps, not because they picked the wrong stock, but because they think about it the wrong way. They treat a 2-year leap like a short-term trade. They check it every day. They panic when it drops. And they quit right before the move actually happens. Meanwhile, smart money does the opposite. They stay calm. They stay patient. And they treat leaps like long-term capital investments. In this video, I'm going to show you how to build a professional trader's mindset so you can manage multi-year leaps the way institutions actually do. 1. The identity shift. Let's start with the most important shift. You are not a trader anymore. You are a portfolio manager. A trader reacts to price. A portfolio manager allocates capital. And a multi-year leap is not a trade. It is a capital deployment decision. Once you understand that, everything changes. You stop reacting to every red day. You stop checking your option every hour. And you start asking a different question: is my thesis still intact? Because that's how professionals think. 2. You are buying time, not price. Most people think they are buying a stock direction. But with leaps, you are actually buying time. Time for the story to play out. Time for the market to recognize value. Time for institutions to accumulate. And this is where most traders get uncomfortable. Because nothing happens, for a while. The stock goes sideways. The option doesn't move much. And it feels like you made a mistake. But this is normal. Professionals expect this. They understand, the market moves in phases. There's an early phase, a quiet middle phase, and then the expansion phase. Most people quit in the middle. Professionals get paid at the end. 3. Ignoring mid-cycle noise. This is where discipline really matters. During the middle of your leap, delta feels weak. Price chops around. Premium slowly decays. And emotionally, it feels exhausting. But structurally, nothing is wrong. This is just the consolidation phase. Think of it like this. Early stage is when you enter, middle stage is when the market builds. Late stage is when the move happens. The biggest mistake traders make is abandoning the position right before the expansion phase begins. Professionals don't do that. They stay focused on structure, not noise. 4. Volatility is part of the game. Let's talk about something most traders can't handle. Drawdowns. If your leap drops 30, even 50%, most people panic. They think something is wrong. But professionals expect this. Because volatility is not a bug, it's a feature. This is why position sizing matters so much. If you cannot emotionally handle the swing, you are oversized. Professionals solve this ahead of time. They size positions so they can stay calm even when the market is not. 5. Stop chasing perfect entries. Retail traders obsess over the perfect entry. The exact bottom. The perfect candle. The perfect timing. But professionals focus on something else: staying power. Because over a 2-year period, your ability to stay in the trade matters more than your exact entry. This is why scaling matters. You don't go all in at once. You enter partial. You add on confirmation. And most importantly, you keep cash. Because cash is not wasted. Cash is optionality. 6. Predefine your plan. This is where you separate yourself from everyone else. Before you even enter a leap, you should already know your plan. Your entry zone. Your risk tolerance. Your management strategy. And your exit timeline. For example, will you hold through earnings? Will you trim into strength? Will you roll when there are 6 months left? If you don't decide this ahead of time, your emotions will decide for you later. And that's where mistakes happen. 7. The real challenge is psychology. Here's the truth most people don't want to hear. Managing leaps is not hard technically. It's hard psychologically. Because it requires patience, discipline, delayed gratification. There will be long periods where nothing happens. There will be times you feel uncertain. There will be moments you want to quit. That's the test. Retail traders need constant validation. Professionals don't. They trust their process. 8. The professional standard. So what does a professional leaps trader actually look like? They think in months and years, not days. They measure success by process, not emotions. They accept volatility as part of the strategy. They size positions to survive, not just win. And they treat every leap like a business investment, not a gamble. So basically at the end of the day, this is the mindset shift. You are not trading options. You are allocating capital into time. And once you start thinking this way, everything becomes clearer. You stop reacting. You start managing. And you finally give your strategy the time it needs to work. If this helped you understand leaps on a deeper level, subscribe to the channel. I break down how to actually manage long-term options using structure, discipline, and real strategy, not hype. Thank you for watching and I'll see you in the next video.